Hi there. Well, with COVID-19 affecting small and medium-sized technology companies, you probably would get the impression venture capital is in a lot of difficulty. It's very variable. People are having to be creative. Here are three examples from our recent experience. These affect investee companies and investors. First, an investee company in which our clients were the lead investor discovered that management had failed to disclose they had criminal prosecutions against the founder. The warranties didn't cover this. I have to say we did not draft these warranties, but there was a loan note on which the company had missed a repayment. So our advice was call a default on the loan, force the company into administration. This was in England. And then, because in this case, our investors were in a position to engineer a buyout, buy the assets from the administrator. Done successfully. Inevitably, the founders were squeezed out of the equity. Second example, another investee company in which our clients were one of several investors. Great technology. Starting 2020 looking for development capital to expand, and at the same time an approach came for an exit from an Asian technology conglomerate. So it was looking like investors were going to get several times their money. Then COVID-19 arrived and that hit their cash flow really badly in this case. Before they could renegotiate rescue finance, given the cash runway was running out, they went into administration in the UK. Our clients in this case were not in a position to organise a rescue buyout, and they were sold to the Asian conglomerate. I don't know the price, but no doubt at a very attractive price. And it remains to be seen whether our investor clients will get any money. Third example was an investment company itself, which had raised its initial seed capital from its investors on loan notes. Now see the plug at the end for my blog on loan notes. These were not convertible notes, so there was a repayment date coming up several months away, but management diligently looked at this and decided to be proactive. So they approached all the loan note holders, all their investors, and I helped them structure an offer with three alternatives for the investors, one of which we were encouraging them to take, obviously, was to convert the debt to equity. And this has gone very successfully. They're likely to clean up their balance sheet completely and have little or no, or certainly manageable debt. Now, that's the moral of the story, really. The best way of rebuilding your balance sheet is with equity refinancing. Alternatives. Negotiate with your banks. They're going to look at you very carefully, so check your banking covenants in your facility agreements that you're not in default, or you could end up in administration or one of the other equivalents in another country. They will look at your financial reporting and probably tighten it. They may stop you doing any M&A in the meantime. They might even ask for more security. Alternatives to banks? Well, it depends on your receivables book in an operating business. If you've got strong receivables, you may be able to do receivables financing. It is more expensive than bank debt, but it's an alternative. And you're only giving recourse over the receivables. Lastly, of course, the obvious thing is to manage your own cash flow, pay your suppliers more slowly, get your customers to pay you quicker. But of course, any sophisticated company is playing the same game at the moment, so you probably have no choice but to try and do the same. So I hope that was helpful. Do look at our blogs on playing around with the terms of loan notes, convertible notes. We've done blogs on whether you're management or whether you're investors, and I hope that's helpful. Thank you.